Hi, this is Clement from Stocks University. In this video, I want to go over one of the most widely used valuation ratios, the PE ratio. We'll cover what it is, its advantages and disadvantages. Simply put, the PE ratio is the ratio between a company's earnings and its share price. The most common way to calculate it is to take the earnings of the past 12 months, the trailing 12-month earnings, often abbreviated as TTM. For example, look at Apple's share price and last 4 quarterly earnings figures in the slide. If we do the math, we find that Apple's PE ratio is a little under 18. In simple words, it means that you are buying a share of Apple for about 18 times its earnings. A lot of investors use this metric as a tool to understand whether the shares they are buying are considered cheap or expensive. However, the PE ratio in a vacuum doesn't tell us much. To return to the previous example, what is 18? Is it a lot? Well, it depends. The PE ratio is relative to the market and to the sector and industry the company operates in. As of today, the S&P's PE ratio is 25, so anything below can be considered cheaper than the market, and anything above is more expensive than the market. It is also best used to compare the PE ratio within an industry or a sector to identify the more expensive and cheaper player in an industry. As for advantages, well, we do need valuation criteria, don't we? The PE ratio's biggest asset is that it tries to help you with an assessment of a company's valuation. We always say that a company is only as good as the price you bought it for. A big advantage of the PE ratio is that it gives an investor a snapshot of two of the most important criteria in a company, its price and its earnings. It also hints at the growth expected from a company. Given the S&P's PE ratio of 25, if I tell you that Netflix's PE ratio is over 200, it tells you a lot. Netflix is expected to achieve high earnings growth over the coming years, or its share price would surely tank. One of the main disadvantages of the PE ratio is that it is sometimes treated as a one ratio fits all. You simply cannot base your analysis solely on this PE ratio. Don't do it. The PE ratio is a great tool, but it is only part of your arsenal as an investor. Another disadvantage is that it doesn't help you with evaluating companies with negative earnings, because the ratio will not return a result. The weak link of the PE ratio is the earnings. Earnings are sometimes manipulated by companies. Accounting methods and gimmicks can make a company's earnings look prettier than they are. Sometimes, a company has a bad earnings quarter because a one-time event like a fine, which causes the PE ratio to skyrocket, while the company's business or long-term earnings power hasn't really changed. To sum it up, like I said throughout the video, the PE ratio is great if you know how to use it and you know its limitation. I've tried to define it, outline the general best practices, and give major advantages and disadvantages to using this popular ratio. I hope you enjoyed this video, and I will see you in the next one.